Mastering Schedule C, Top 10 Deductions every small business owner must know. Welcome back to Tax Insight for Business, the channel where we demystify taxes for small business owners and entrepreneurs. I'm Professor George, your guide on this journey to unlocking significant tax savings. Today's focus is on the crucial deductions on Schedule C that can transform your tax strategy and boost your bottom line. Whether you're a seasoned entrepreneur or just starting, understanding these deductions is key to minimizing your tax liability. So let's embark on this tax-saving journey together. Don't forget to subscribe, hit the like button if you find our tips useful, and ring the notification bell to stay ahead in your tax game. Let's dive in. First on our list is advertising expenses. In the digital age, advertising is more than just an expense. It's an investment in your brand's visibility and growth. From social media campaigns to traditional flyers, every penny spent on promoting your business is potentially deductible. But how do you ensure you're maximizing this deduction? Let's break it down. To maximize your advertising deductions, start by keeping impeccable records. Every campaign, no matter how small, should be documented with dates, costs, and the advertising medium used. Use accounting software like QuickBooks to categorize these expenses accurately, making tax time a breeze. Consider this scenario. You launched a Facebook ad campaign and a local newspaper ad, costing you a total of $2,000. Both are fully deductible, but only if you've kept detailed records. Now, imagine reducing your taxable income by this amount. The impact on your tax bill could be significant. It's also important to strategize your advertising spend. Investing in targeted ads that reach your ideal customer can not only improve your return on investment, but also ensure that your advertising expenses work double time, growing your business and reducing your taxes. In conclusion, don't view advertising as just another line item on your expenses. View it as a strategic tool for both business growth and tax savings. Keep thorough records, categorize each expense, and consult with a tax professional to ensure you're capitalizing on every opportunity. Stay tuned for our next segment, where we'll delve into vehicle expenses and how to track and deduct them effectively. If you're finding value in our discussion, remember to subscribe to Tax Insight for Business. Give us a thumbs up and don't hesitate to reach out for personalized advice through our website at boweraccounting.com or directly at georgebaueradvice.com. Your journey to a more profitable and tax-efficient business is just beginning. Moving on to our second vital deduction, vehicle expenses. For many small business owners, a vehicle is more than just a mode of transportation. It's a critical asset for operations, client meetings, and supply runs. Understanding how to track and deduct these expenses can lead to substantial tax savings. Let's navigate through the essentials. Vehicle expenses can be deducted in two ways, using the standard mileage rate or actual expenses method. The standard mileage rate is straightforward, offering a per-mile deduction for every business mile driven. For tax year 2023, the rate is 65.5 cents per mile. It simplifies record keeping, requiring only a detailed log of miles driven for business purposes. Alternatively, the actual expenses method involves deducting the actual costs of operating the vehicle for business use, including gas, repairs, insurance, and depreciation. This method requires meticulous record keeping but can offer larger deductions for vehicles with high operating costs. Consider this. You drive 10,000 business miles in a year. Using the standard mileage rate, your deduction would be $6,550. Now, if your actual expenses, gas, maintenance, insurance, total $7,000, the actual expense method would yield greater savings. The key is to analyze which method benefits your business most annually. But here's the catch. You must choose your method in the first year the vehicle is available for use in your business. After the first year, you can switch methods, but there are restrictions. For leased vehicles, if you choose the standard mileage rate, you must use it for the entire lease period. Tracking is crucial, regardless of the method. For the standard mileage rate, maintain a detailed logbook or use a mileage tracking app. For actual expenses, keep all receipts related to vehicle costs. And remember, only business-related expenses are deductible. Personal use is not covered. In summary, vehicle expenses offer a significant opportunity for tax savings. Choose the right method, keep impeccable records, and consult with a tax professional to ensure you're maximizing this deduction. Up next, we'll explore office expenses, another key area where smart planning can reduce your tax liability. Stay tuned. Moving on to another critical deduction for small business owners, office expenses. Whether you're leasing a space downtown or running your business from a home office, the costs associated with maintaining your office are broadly deductible. This encompasses more than just your monthly rent or mortgage interest. It includes utilities, office supplies, and even that coffee maker that keeps you going through late-night work sessions. Firstly, organization is key. Start by keeping all receipts related to office expenses, no matter how insignificant they may seem. This includes everything from your internet bill to the pens and paper used daily. Categorizing these expenses in your accounting software, like QuickBooks, will simplify your life when tax season rolls around. For those of you working from a home office, distinguishing between personal and business expenses becomes crucial. Utilities, for instance, can be partially deductible based on the percentage of your home used for business. Accurately calculating this portion requires a clear understanding of the rules, which we'll cover in depth in a future video. Investing in quality office equipment is also a smart move for any business owner. Not only does it enhance productivity, but items like computers, printers, and furniture can be deducted, either through Section 179 expensing or by depreciating their cost over several years. The choice between these methods depends on your specific financial situation and business model. To sum up, effective management of your office expenses can lead to substantial tax savings. Keep meticulous records, make informed purchasing decisions, and use technology to streamline the process. Remember, every dollar saved on taxes through legitimate deductions is a dollar that can be reinvested in growing your business. Next in our journey through vital Schedule C deductions, we delve into supplies. For any business, large or small, supplies form the backbone of day-to-day operations. From the ink in your printers to the cleaning supplies keeping your workspace pristine. These expenses, while seemingly minor, can accumulate and impact on your bottom line. The first step in managing your supplies expense is understanding what qualifies. The IRS defines supplies as tangible items used and consumed in your business. This doesn't just mean stationery, it extends to any consumable item used during business operations. Let's talk about substantiation. The IRS may require proof of your supply expenses. This means keeping receipts, invoices, and even notes on how each item was used in the business. Digital record keeping can be a lifesaver here, allowing for easy retrieval and organization of documents. In conclusion, supplies may be a small part of your overall expenses, but they're crucial for both operations and tax efficiency. By keeping detailed records, making smart purchasing decisions, and understanding what qualifies as a deductible supply expense, you can ensure you're not missing out on valuable deductions. Stay tuned for our next segment, where we'll dive into travel expenses, another area where strategic planning can lead to significant tax savings. And remember, for personalized advice tailored to your unique business needs, don't hesitate to reach out. Our journey through the essential deductions on Schedule C brings us to travel expenses. For many small business owners, travel is a necessary part of operations. Whether it's attending industry conferences, meeting with clients, or scouting new locations, understanding how to correctly deduct these expenses can turn necessary travel into a significant tax advantage. Let's navigate the ins and outs. Travel expenses encompass everything from transportation costs, lodging, and meals to other incidental expenses incurred while away from home on business. The key to maximizing these deductions lies in differentiating between business and personal travel. The IRS is clear. Only travel expenses related solely to your business are deductible. Effective tracking starts with meticulous documentation. For every trip, maintain a detailed log that includes the purpose of the travel, the duration, and a breakdown of all expenses. Leveraging digital tools or apps can simplify this process, allowing you to capture receipts and notes on the go. Let's dissect a common scenario. You're attending a 3-day industry conference across the country. Your airfare, hotel stay, and 100% of your meal expenses during these days are deductible. However, if you extend your stay for personal reasons, expenses incurred during the additional days are not deductible. Clarity and honesty in documenting these expenses are paramount. A word of caution, the IRS pays close attention to travel deductions. Ensure your documentation is bulletproof. This means keeping all boarding passes, event registrations, and hotel invoices. An organized digital folder for each trip can be your best defense in the event of an audit. In summary, travel can be both a necessary business activity and a valuable deduction opportunity. Always ask yourself, how does this trip serve my business objectives? Document rigorously and use technology to your advantage to ensure you're maximizing every deductible dollar. Another area ripe for deductions is meals. Whether dining with clients or grabbing lunch while on a business trip, the cost of business meals can contribute to your tax savings. However, navigating the rules for deducting meal expenses requires a nuanced understanding of IRS guidelines. Let's digest the details. The IRS allows for a deduction on meals that are directly related to your business. This includes meals with clients where business is discussed, as well as meals during business travel. The criteria? The expense must be ordinary, necessary, and not lavish or extravagant. Effective tracking is crucial. For each meal expense, record the date, location, attendees, and the business purpose. Apps that allow you to snap and store receipt images along with these details can significantly streamline your record keeping. Substantiation is key. While the IRS doesn't require receipts for expenses under $75, it's still a best practice to keep them. This documentation can prove invaluable if your deductions are ever questioned. Remember, it's not just about claiming the deduction. It's about defending it if necessary. In closing, meals can be a delicious deduction for your business, but they require meticulous documentation and a clear business connection. As we wrap up this segment, remember that every expense you track and deduct is an investment in your business's bottom line. A topic of paramount importance to many of you watching is the home office deduction. In our evolving work landscape, more entrepreneurs than ever are discovering the benefits and challenges of working from home. This deduction allows you to claim a portion of your home expenses, provided your space meets certain criteria set by the IRS. Let's unfold how to qualify and calculate this advantageous deduction. For your home office to qualify for a deduction, it must be used regularly and exclusively for business. This means your office should be a distinct area in your home where you conduct your business operations, not a multi-purpose space. The IRS offers two methods for calculating this deduction: the simplified option and the regular method. The simplified option allows you to deduct $5 per square foot of your home office, up to 300 square feet, offering a maximum deduction of $1,500. This method requires less paperwork and is an excellent choice for smaller home offices. The regular method involves calculating the actual expenses of your home office. This includes a portion of your mortgage interest or rent, utilities, property taxes, and maintenance costs, proportional to the size of your home office compared to your entire home. While more complex, this method can yield a larger deduction for those with significant home office expenses. Documentation is crucial. Keep all receipts and records related to your home expenses, as well as a diagram of your home office with measurements. This not only aids in calculation, but also serves as substantiation in case of an IRS inquiry. The home office deduction is a powerful tool for small business owners, offering tangible financial benefits. However, its complexities necessitate careful consideration and often guidance from a tax professional. By understanding and accurately applying this deduction, you can significantly reduce your taxable income. Now let's turn our attention to an area that can significantly impact your tax situation: deducting depreciation. This powerful deduction allows you to spread the cost of buying assets for your business over the years they're used, rather than taking the full hit in the year of purchase. Understanding how to leverage depreciation can provide a substantial boost to your tax efficiency. Depreciation applies to tangible assets with a useful life of more than 1 year. This includes everything from office furniture and computers to vehicles and machinery used in your business. The first step is to determine the depreciable basis of the asset, which typically is its cost, including any related expenses to acquire and make it ready for use. The IRS offers several depreciation methods, including the straight line method, where you deduct an equal amount each year over the asset's useful life, and the accelerated depreciation methods, which allow for larger deductions in the early years. Choosing the right method depends on your business strategy and financial goals. Keeping accurate records is crucial. You'll need to track the purchase date, cost, and depreciation method for each asset. This information is vital not only for your annual tax filings, but also if you sell the assets or if your business is audited. Strategic planning around depreciation can significantly affect your business's cash flow and tax liability. For example, the Section 179 deduction and bonus depreciation are provisions that allow for immediate expensing of certain assets. offering immediate tax relief. However, these rules are subject to change and may not apply to every business or asset. Stay with us as we move on to our next topic, insurance deductions, to further explore how you can optimize your tax situation. And, as always, for complex topics like depreciation, consulting with a tax professional can provide tailored advice and peace of mind. As we advance through our exploration of key Schedule C deductions, let's shed light on insurance deductions. Insurance is a fundamental aspect of safeguarding your business, from general liability to property and even health insurance for yourself and your employees. Fortunately, these necessary expenses are also deductible, offering not just security but also tax benefits. The range of deductible insurance premiums is broad. This includes not only the policies directly related to your business operations, such as liability and property insurance, but also health insurance premiums if you're self-employed. Understanding which premiums are deductible and how to properly deduct them is crucial for maximizing your tax savings. First, let's talk about health insurance, a significant expense for many. If you're self-employed, you can deduct 100% of your health insurance premiums for yourself, your spouse, and your dependents. This deduction is taken on your personal tax return, adjusting your gross income rather than as a Schedule C deduction. For other types of insurance, meticulous record keeping is key. Keep detailed records of all premiums paid, and ensure these policies are strictly for business use. Mixed-use policies like auto insurance for a vehicle used both personally and for business require careful calculation to determine the deductible portion. A word of caution: life insurance premiums where the business or business owner is the beneficiary are generally not deductible. It's nuances like these that highlight the importance of understanding the specifics of insurance deductions. In conclusion, insurance deductions offer a way to lower your tax liability while protecting your business assets and well-being. Whether it's health, liability, or property insurance, make sure to leverage these deductions fully. Just remember, the key to maximizing these benefits lies in ensuring that policies are clearly for business use and keeping impeccable records. Wrapping up our exploration of the top Schedule C deductions, we come to an area that benefits your future as much as your present: retirement plan contributions. For small business owners, investing in a retirement plan is not just a step towards securing your financial future. It's also a smart way to reduce your current tax liability. Let's delve into how you can make the most of this opportunity. Whether it's an CP IRA, a solo 401k, or a simple IRA, contributing to a retirement plan allows you to deduct those contributions on your tax return. This deduction can significantly lower your taxable income, translating into immediate tax savings, all while building your nest egg. Each retirement plan has its own set of rules and contribution limits. For instance, SEP IRAs allow contributions of up to 25% of your net earnings from self-employment, with a cap that adjusts annually for inflation. Choosing the right plan depends on your business structure, income, and retirement goals. Planning your contributions requires a delicate balance. It's about maximizing your current tax savings while ensuring you're setting aside enough for a comfortable retirement. Regular contributions, even in smaller amounts, can grow significantly over time thanks to compound interest. In summary, contributing to a retirement plan is a win-win. You're not only preparing for a financially secure retirement, but also enjoying tax benefits today. As we conclude our series on maximizing your Schedule C deductions, remember, the key to optimizing your tax situation is a combination of strategic planning, accurate record keeping, and, when in doubt, consulting with a tax professional. Thank you for joining me on this journey through the top 10 Schedule C deductions for small business owners. If you found this series helpful, please subscribe to Tax Insight for Business. Give us a thumbs up and hit the notification bell to stay updated on all our latest content. For personalized advice and further insights, don't hesitate to visit our website at boweraccounting.com or reach out directly at georgiabaueradvice.com. Together, let's ensure your business is as financially healthy as it can be. And don't forget, for tips on balancing a successful business with a healthy lifestyle, check out our Keto Kitchen CPA channel. Here's to your success, both in business and in life.